Welcome back to the Investor Professor Podcast. This is Dr. Ryan Peckham, and this is episode 147. Wow, we have been whipsawed the last 2 weeks. Market goes down, market comes up. We'll talk about that. We'll talk about some strategies going into the Fed meeting this week. It's going to be a big one. And then we're also going to talk about the rise of sports gambling and how that can impact your portfolio. So, in a particular segment of individuals are gambling a lot. So we will discuss that all in today's episode 147. So get your mind right and let's get to work. Welcome back to the show, everybody. And thanks for joining me again. Man, I miss 1 week, and I say this every time I don't record an episode, I'm like, geez, that would have been a good week to do one. So the last couple of weeks have been quite interesting in the market. That's the reason I named this episode Whiplash, because that definitely is what it feels like when you think about what's happened with the market over the past couple of weeks. And man, if you're watching this on YouTube, I have sticky notes. I live and die by sticky notes, and so I'm sitting here looking for the one I did on this episode on what I wanted to talk about. Well, when you look at what happened in the market over the last couple of weeks, it's pretty interesting. So 2 weeks ago, the Nasdaq lost 5.8%, and then this past week it gained 6%. The Dow Jones lost 2.6%. 2 weeks ago, and then this week it gained 3%. So we are seeing that whiplash effect, kind of getting moved around here. But as we discussed so many times on this show, I think I've said it more in the last couple months than I have during the entire period of the show. But most of the good days in the stock market happen within 2 weeks of the worst days, and so we've seen that happen time and time again. So I hope you're using those bad days to kind of improve your portfolio, improve some of your positions. I've done that in some client accounts where maybe I feel like I have some shares that are too high. The cost basis is a little too high. So I'm using some of these good days to trade out of those. And then I put in some limit orders to buy some of those shares back when it goes lower. So you can always do that. So remember, a limit order, let's say a stock's $200 a share right now. I can do a limit order on the computer. Say I want to put a limit order at $190, and it'll sit on the computer for the next 6 months. And if it dips down to that 190 mark, then it will go ahead and buy those shares for me. So there's little things you can do like that, which again, it doesn't seem like a big difference. But over time, if you have some shares that you thought were too high and you can get out of those shares and then lower your cost basis, over time, it can make a big improvement just on your portfolio using these kind of whiplash days and weeks to your advantage. And so, that's probably not going to change this week. So this week we have the Federal Reserve. They're going to meet again. And this past week we had CPI, we had PPI. The numbers were better. They weren't great. And so I think what makes me nervous going into this week is that the market is looking at maybe a 50-50 shot that the Fed's going to lower interest rates by 50 basis points on this first rate cut. This could be completely out of date, and I could be completely wrong 3 days from now. But I just don't see them lowering the interest rates by 50 basis points. I think that Jerome Powell and the Fed will do 25 basis points. It just seems to be the way that he, operates. And I don't think they want to send a signal to the market that there's, if they cut 50 basis points, there's a certain percentage of the market who will take that as maybe the Fed sees something that we don't see, that they're nervous about. So they're trying to hypercut, from the get-go. And so I'm not sure that's the signal they want to send to the market. So they meet in September, so the meeting that they're going to have this week. And then there's not a meeting in October, and they meet again in November and December. So I would expect that they're going to lower by 25 basis points, see how that impacts the numbers, for September, October, and then reevaluate in November. So I think they'll probably, cut 25 basis points every meeting until the end of the year, depending on how the numbers look. And so, again, it's not something that I'm not placing trades and things based off of that. I think there's a lot of investors, speculators in the market that are doing so. When you look at what happened this week, and you see that big increase in the Nasdaq and the S&P 500 and the Dow this week, everything did really well this past week. Part of the reason for that was the fact that there's a certain contingency in the market who expects them to do a 50 basis point rate cut, and so we shall see how that goes. But it should, relieving the 25 basis points, lowering mortgage rates, lowering the cost of money should be good for some industries that have felt a lot of pain over the last 18 months because of the interest rate increases. But again, because they lower it 25 basis points doesn't mean you're going to see a lot of improvement right away. It takes a while for those rate cuts, just like the increases. It takes a while for that to work its way through the economy and for banks to change rates and for consumers to change their behavior and that sort of thing. So we'll see how that goes. And then obviously the action that they take is going to be important. But you'll see two moves. They'll read the FOMC statement, and you'll see one move from the market. And then there's probably going to be another one when they actually do the press conference, which is normally what is the expectation about the future, right? So the market's always looking for what's going to happen in the future. And so November is going to be a big month. So this is going to be the Fed meeting, the last one before the presidential election, and then their next meeting will be after the election. So, that's the other, conspiracy theory is they're not going to lower by 50 basis points because they don't want it to have an impact on the election, and all the different things. So, speaking of, I made a joke this past week, and if you're not in America, I apologize for this joke. But the presidential election was this past week, and I always wonder if Saturday Night Live, the comedy show Saturday Night Live, is just like, man, we don't even have to work this week. Let's just take the transcript and just read this thing verbatim, and we got our show. So lots of craziness in these debates, but our job as investors, especially my job as a money manager, my job is to make money no matter who's president, no matter who's elected. And so I will continue on that path. One of the good things, so on September 23rd, there are going to be new members of the S&P 500. And so those new members of the S&P 500 are going to include Palantir, which we've talked about a lot on this show, Dell, which we've also talked about, and then another company that I don't know much about, Erie Indemnity, is also going to be added to the S&P 500. So I thought it would be good for you to know, what does it take for somebody to be included in the S&P 500? Well, they have to be a U.S.-based company, right? So it's the 500 most profitable U.S. firms. They have to have a market cap of $18 billion. They have to have so many, traded so many minimum number of shares over the past 6 months. But their most recent quarter of GAAP earnings, so GAAP standing for Generally Accepted Accounting Policies, Generally Accepted Accounting Policies. So the way that they do their books, right, is the accepted version. So most recent quarter of GAAP earnings have to be positive, as well as the previous 4 quarters should be positive. So I wanted to bring this up because we have done this with Uber, and now we have done this with Palantir. And so when you find companies that aren't profitable yet, but they're on a path to profitability, you can do quite well with your rates of return on certain companies. So Palantir, when this was announced that they're going into the S&P 500, the stock immediately jumped from $30 a share up to $34. And currently it's at $35.73 after hours when I'm recording this on Sunday, September 15th. So Palantir jumped on those, the S&P, because all the mutual funds, all the ETF, the exchange traded funds that follow the S&P 500, they now have to buy shares of that company. So investors jump in, they buy those stocks before they get included in those indexes, and it really gives them kind of a floor. So if you look, when we were recording these podcasts back in 2022, 2023, Palantir got down to $6.42 a share. I believe we started talking about it around $9 a share, somewhere around there, 9 or 10. And the big key on that was, for me, when I looked at them and found them as kind of an investment, was they had a lot of government contracts, which government contracts are fantastic because they're going to get paid. And so looking at them and seeing how they get closer and closer to that profitability was certainly key. The same thing happened with Uber. And so we've done a great job on those companies and always looking for those types of companies that are going to get better and better. Dell, of course, Dell has started to pivot their business from just doing computers to doing a lot of servers and installs for NVIDIA and the NVIDIA chips. So when you order NVIDIA chips, you got to have somebody install them. You got to have somebody help you build the infrastructure needed to power those. And so Dell is in the sweet spot for being able to do that. So two very, very good companies. And, looking at those, we'll see. Maybe Kava will get there one day. That's a company we've discussed. And so just looking for those kind of growth, those young growth companies that will end up being profitable firms and doing well. Another one that I've been looking at is Affirm Holdings. And again, this is not a recommendation. Do your own homework. Talk to your financial advisors for entertainment purposes only. All of that good stuff. But Affirm is kind of the key on buy now, pay later, which a lot of much younger demographic. So not so much credit cards, but doing buy now, pay later. If the economy starts to, tighten up, people aren't doing as well, they carry more balances on their credit card. Affirm will probably be doing better business on buy now, pay later. And so not one that I've done anything with yet, but definitely looking at it. If you look at their earnings per share, they've been negative. So they are an unprofitable company at this point. But I think, if they continue to do what they're doing and the trends that are going on, they could at some point hit profitability, and maybe we'll be talking about Affirm one day. So we shall see. Get a drink real quick. Okay. So the other thing I wanted to touch base with in this episode is the rise of sports gambling and the impact that it's having on, or could have on, investment portfolios, just general habits of people who are young. And this is not going to come as a surprise to you, but in a survey of sports gamblers, 72% were male. So when we look at investing, we also see that the riskiest investors on the planet are young men. It's not a surprise, right? But with the advent of, fantasy football and apps where you can bet, it's becoming like tremendous. Every time you see these articles that come out, it's the amount of money that people are gambling. It's the kind of the issues that come about that. And so I just wanted to have like a little general conversation here where, that money that some of the younger demographics are using for sports gambling could obviously go towards investing, right? And so when you look back to 2020, when we had COVID, and you saw that sports gambling went away because sports went away for a while, right? And then you saw that massive increase into risky assets in the market. So you saw Dave Portnoy with Barstool Sports. He became Davey Day Trader, started doing YouTube videos, telling people which stocks to go after. We saw the GameStop, we saw the NFTs, we saw the Bored Ape Club, NFTs being sold and stuff. And so there's always needs to be an outlet for risky investments. But I mean, man, my goodness, when you're putting the amount of money, sometimes when I just talk to people that I know, and the amount of money that they're gambling with every single week, it really becomes amazing to me, because I'm like, well, how much money are you saving? How much money are you investing? And for a lot of the ones that I've talked to, it's been a much lower number. And so for me, it's a little bit scary, because when you look at starting to invest when you're young, I mean, you just can't get those years back. You cannot get those years back. And so we think that we have all the time in the world, but we really don't. And so I'm going to try to maybe do this in one of my classrooms and kind of show the numbers on this. I'm going to try to do it right now verbally, but I think if I can follow this up with a video that shows this, it'll make a big difference. So I'm teaching about time value of money right now, which is, if you look at compounding, all of those things, how does that end up later on? Well, there's an exercise we do where we talk about somebody who's starting to retire at the age of 35. So somebody who is like, they say, hey, I'm 35 years old now. I want to get serious about retirement. I'm going to start putting money back. How much are we going to have later on? So if you have somebody who's 35 years old, they save $10,000 a year for 30 years. So 35 to 65, they're saving $10,000 a year. And they grow at like 10%. Well, that's going to grow to about 1.6 million. Okay? About 1.6 million. If you have somebody who starts at 25 and they put money back until they're 45, so 25 to 45, they save the same $10,000 a year. They make the same 10% a year. At 45, they turn it off. They don't put any more money into that account at 45, but they let it grow to 65, like the other person. They'll have more than double. I think it's 3.4 million. I got to check these numbers, but I think about 3.4 million. The other person will have 1.6. The other person who waited till they were 35 and saved from 35 to 65 will have put in $300,000. So that 30 years times the $10,000 they're doing, they would have put in $300,000 contribution. The person who started at 25 and saved from 25 to 45, so 20 years, and they're putting back $10,000, they would have saved $200,000. So they contributed $100,000 more, and they end up with more than double the amount. And it's like, how does that happen? Well, that happens because of compounding. And it's not about being the what happens in the early days. It's what happens in the later days. So they get one more double because they started earlier, right? So we've talked about the rule of 72. You take a number divided by 72. That's how long it'll take your money to double. So at 10%, 72 divided by 10 is going to take about 7.2 years for your money to double. So if you start at 25 versus 35, you're going to get one extra double. And that's why everybody who's older tells everybody who's younger that they need to start investing earlier. But the problem is, when you're 25, you have, maybe you want to buy a car, maybe you want to buy a house, like you're trying to get your life started. People in their 20s normally are trying to get back to the standard of living they had with their parents. And so it becomes quite difficult. But then you throw in sports gambling, and somebody's throwing away $50, $100 a week, maybe even more. I've talked to some of people, I had no idea they were gambling. They're spending like $300 to $500 a week on sports gambling. And so if you're gambling that much and you're not doing any kind of investment program, I mean, you just got to put up some guardrails. I'm not saying you can't sports gamble. I'm not saying you can't, do fantasy football and all that kind of stuff. I mean, we can talk about the productivity loss at some point. I mean, I have some friends that, doing 3 fantasy football leagues. I mean, it's literally a part-time job. What else could they be doing with their time? And I get it. Like I'll throw $100 on something every once in a while, but to do that every single week, and with the access that is now available, with so many people being able to do things on their phone, and it's just so accessible to be able to do these kind of things. It's just, you got to be really, really careful, because it is a very slippery slope. All of a sudden, you've spent a lot more money than you thought you were going to spend. And you can really put yourself in a hole financially. And it's not just the money that you lose or win. Obviously, there's some winners. The money you lose, but on a whole, on average, there's not going to be a lot of winners. it's not just the money that you lose from the gambling. It's the number that you can't measure. It's the number of omission by not starting to invest in something that's truly going to give you financial freedom later on. So it's the, how much are you willing to pay for that entertainment, but at what cost? What, how much of a detriment is that going to be on your financial future because you didn't start investing while you were younger? So again, just be careful. Not everything's measurable. If you don't save money, if you're not investing, it can be, you're just not going to be able to keep track of like how much that you what you could have invested in, right? What you could have invested in. And so there's a big problem with, we won't even discuss all the issues with compulsive gambling, how many people end up, really having a very detrimental impact to their financial lives and futures and all those things. But I get it. I mean, it's, they've done a good job of camaraderie and, making you feel like you're not, you're left out if you're not doing some of that. But again, you just have to make sure it's something that you put some boundaries on and you set a limit just like you would on any other part of your budget, right? So, and make sure that you're still investing while you're doing those things. All right. So this week we talked about the Fed meeting coming up. We'll discuss that. What's going to happen with the market? Is it going to be 25 basis points? Is it going to be 50? I still say it's going to be 25 basis points. Look at some of those stocks that are going into the S&P 500, but do your own research and try to find some that are small companies growing fast that you think are going to get to profitability, and don't let the whiplash of the market, play with your emotions, right? So remember, use those bad days to invest, change your cost basis and things, use the high days, because it's not going to be straight up from here to the election. There's going to be more whiplash going into the election. That's the way this is the way presidential elections happen. So, if you're aware of it, if you don't panic, you can use it to your advantage. So as always, don't mistake activity for achievement, and I'll see you next time. Thanks, everybody.